Assalamualaikum and hi. So for today's chapter, we will learn about accounting for accounts receivable. And the learning objective of this chapter is to differentiate between bad debts and allowance for doubtful debts, and to make adjustment on account receivable for bad debt expense and bad debt recovered. For introduction, it is common for business to sell goods on credit to customers. So offering credit terms expose a business to the risk of some customers not paying for the goods sold or services rendered to them. And in case of some customers unwilling to pay, the receivable are no longer become assets to the company and must be reduced. So bad debts and allowance for doubtful debts. There are two methods used to record bad debts and allowance for doubtful debts. The first method is the direct write-off methods, proven that receivable cannot settle a debt. And then second is the allowance method, when there is possibilities a few receivable might not be able to settle the debts.
The first method is direct write-off method. If it is proven that a receivable cannot settle their debt, even though reminders have been sent to them, the amount that cannot be recovered from the receivable will be known as bad debts. And a bad debt is considered as an expense to the business in the year it was written off. Therefore, as an expenses, it should be recorded in the statement of profit or loss. The justification of using this method is on the basis of immateriality and normally adopted by small businesses. In this example, it shows how you want to record the journal entry if you come across any bad debt transaction. For example, in the books of a sole trader or sole proprietor, on 1st December 20x1, it was found that Ali and Ahmad owe 300 and 500 respectively. Reminders were sent to them, but they failed to settle their debts. The sole trader decided to write off the whole amount as bad debts on 31st December 20x1. So how you want to record this transaction? First, you have to record bad debts written off from account receivable, meaning deduct the bad debt portion from the account receivable. Therefore, you have to debit bad debt account and credit account receivable Ali 300 and Ahmad 500. So the total debit figure is 800. And then you have to close the expenses and transfer it to statement of profit or loss. Other than direct write-off method, there is the second method, which is allowance method. So this method is based on the accounting concept to do not overstate the amount of asset owned by the business. Therefore, in a normal world, there are possibilities that a few receivable might not be able to settle their debts. Estimation should be made as to the amount that will not be able to be collected in the year the sale occur. So one of the method used in estimating doubtful debts is the percentage of account receivable method, which is equivalent to the allowance for doubtful debts equal to account receivable, the debt amount, times some percentage that is decided by the business owner or the company. In the first accounting period, the doubtful debt estimated will be recorded in full. In the next and following accounting period, only the increase or decrease in the estimation is recorded. For example, a business started on 1st January 20x2. The accounting period will end 31st December each year. Therefore, the total amount of account receivable at the end of accounting period is 20,000. It is estimated that 2% of this account receivable will eventually go bad due to certain reason, but there is no evidence whether these debtors are bankrupt or dead. Allowance for doubtful debt should be calculated as follows. The net amount of account receivable, which is the 20,000, and then it is estimated that the doubtful debt is 2%, so we just take 2% from 20,000, so the amount of allowance for doubtful debt should be 400. So to record this transaction, the increase in doubtful debt estimation should be recorded as debit doubtful debts and then credit allowance for doubtful debts. And then to close the doubtful debt account, we should record it as debit statement of profit or loss 400 and then credit doubtful debts 400. Noted that the doubtful debts account is treated similarly as bad debt accounts, whereas the allowance for doubtful debt should be recorded as in contra to the account receivable in the statement of financial position, meaning that in your statement of financial position, after recording your account receivable closing balance, you have to minus the allowance for doubtful debts. Now that you have learned to differentiate between bad debts that come up from the direct write-off method and also allowance for doubtful debts that come out from the allowance method. So let's move on to how to make adjustment on account receivable for bad debt expense and bad debt recovered in the next session. Make sure to click on the next video to find out more. Thank you.